morning. Did you guys have fun with the homework solution? It was clear, the answers to the first homework. You didn't have time to look at it. One person's nodding, the others didn't even look. But it's coming, the exam is coming. So you're gonna have to look at it. Don't worry, it's gonna be fun. And did you have a look at the second homework about central banking? It's pretty much the same format of questions as the first homework, as the final exam. Right? All good? Nice. Any questions about anything that came to your mind over the weekend? All right. Well, we're moving on. We're talking about debt. You should know by now that money is no different than debt, okay? That equity is not much different than debt. But let's look at what people call debt out there. Yeah, question?
I have a question to the solutions of the homework. I just have to.
Okay. I don't know if I have it loaded in my memory. Maybe.
Afterwards, okay.
Yeah, so this is a good reference book. I mean, really not necessary, but just to put it out there. This is kind of a standard generalized formula. The price of any future cash flow is what you incur in costs today, or if you get some cash back today, plus whatever you'll get in the future discounted at the appropriate discount rate. It's a tautology, right? You know this word tautology, meaning the definition of this R is determined simultaneously with this price. Okay, if you have one, you have the other. And that's one of the behavioral biases that people say, oh, interest rates are gonna go up, they went up, and when interest rates are gonna go up, then the prices of the assets will go down. That's a tautology, okay? But people in this profession, they think that somehow discovering this and saying this all the time, and other people, wow, yeah, if interest rates are gonna go up, that's a risk. That's why we shouldn't invest, except maybe in your fund. It's out there. I mean, this is the max that people reach as far as their understanding, and I want you to get rid of it. So we're gonna reach, hopefully, at the end of this course, my lecture about behavioral biases in finance and stuff that economists say. And there's a huge collection of things, and you're gonna find it very useful because this is what people say, but nobody knows the basic accounting of it, but you do. And then you'll be able to make progress in your careers thanks to this knowledge. Well, this is pretty standard knowledge. So a loan, there's just some terminology: par value, face value, notional amount. Okay, so the face value or the par value or the notional value, this is what should be paid at the end of the loan, or sometimes you say notional amount. This is what the amount that a derivative is making reference to. Hi, good morning. Okay. And principal amount is very clearly defined. This is the eigencapital that is borrowed and is lent. Okay? You have to always remember every loan has a borrower and a lender. And also going back to our last lesson about central banking, people say a lot, oh, interest rates are going to go higher, and then then people wouldn't be able to pay their debt, and then the world will collapse, and therefore we deserve to be on Bloomberg, even that we don't invest our own money. But you have to remember that every interest paid is interest earned. Okay? There is no such thing. If you pay interest, you pay to someone. It could be the government, it could be the central bank, or other way around. Every interest paid is an interest earned. So when some people get poorer because maybe some interest rate reset to a higher interest rate, some other people get richer. So you cannot say that what will happen to the economy as a result of this. Okay, not in this class. Your other classes will tell you lots of things about theory, but I will tell you that the fact is that you can never say if it's gonna go one way or another, because there's always different examples. Yeah.
The face value, is it expressed, as is it discounted, or is it just the future value?
Depends on context, but it's usually the future value. And the principal is the present value, usually. Sometimes they coincide if the coupon is equals the interest rate, but again, this is not about memorizing. It's just getting familiar with some of these terms, and as we go through this, I'll think of things, you know, I have things inside me that I want to tell you, to share with you, and as we go through these definitions, these things will come up. All right, the coupon rate, the interest rate. So sometimes a bond would pay a coupon regularly or irregularly. Sometimes it would be a zero coupon, meaning that you lend this company money today and you'll receive one payment at the end of a year or of several years, and that payment will include in it an interest component. Just to remind you that bonds and loans have been around since forever, okay? Also, money is a loan. It's a liability, so it's a loan. But bonds and loans have been around since forever, okay? So the idea that so many people are employed in this industry, calling themselves academics and economists, and all they say are different theories of why things can go badly. And they're right. Every time that they say that things can go badly because this or that, that's correct. But they say this their entire careers, 20, 30, 40, 50 years. And they never invest their money, and they never tell their clients to invest their money. And this is a profession. They get a salary from some institution from giving out these opinions about different ways to see things, how they can go badly, and therefore one should not invest. And it kind of negates the entire profession. But the profession has been around since forever. People don't just make loans, you know, because expecting to make a loss on them, right? People don't just give loans expecting to make a loss. And people don't take loans unless they need them for a profitable activity, or if they really need it because to finance consumption, which they can't. And people won't lend. People don't lend. And people don't finance with equity. People don't buy equities if the price is too high, if they're expecting a loss on this. Finance is inherently a profitable activity. Otherwise, it wouldn't exist forever. It's a basic human activity, okay? You can't spend your entire career saying that asset prices are too high and nobody should invest. Because the money is anyways invested, I've explained to you. Even money in the bank is invested. It's a loan to the bank, and the bank is utilizing this to make a loan to other clients. And what money the bank doesn't utilize is deposited with the central bank, which by definition utilizes this as a source of fund to make a loan to mortgages or to the government. I think this is nice. This is from the Dutch East India Company. A loan versus a bond, there's really not much difference. There's really not any difference. Just that a bond's legal agreement and covenants are much more detailed. Okay? You kind of start as a loan and you graduate as a bond. So a bond would have many, many more covenants, much more disclosures on the issuer. The issuer is the borrower, either a person or a company. Usually individuals don't issue bonds, it's just companies or governments issuing bonds. Bonds would usually list on an exchange and allowed to trade on secondary markets. So after the initial borrowing, where the company borrows the money from the public, then these pieces of paper entitling the bondholder to the future interest and principal repayments, these things can trade to other people, Okay, so always keep in mind the difference between the primary market, which is actually the borrowing market between the issuer and the investors, and the secondary market, which is buying and selling of these assets after they've been issued between different investors. Okay, and what you see in the stock market going up and down, that's the secondary market. That's already after the real financing work took place. Okay, so if you really want to be financiers, to match borrowers with lenders, when I say borrower, it could also be a company issuing equity. Okay, it's not much different. When we reach next lesson, we're going to talk about equity, and I'm always going to bring your conscious back to understanding that equity finance is more similar to debt finance than it is different. A lot of people will spend their entire careers just looking at the charts up and down, imagining patterns, imagining stock prices follow the rules of Newtonian physics. If they went up, they must go down, or if they went down, they must go up. Things don't work this way. And they would forget that there's a borrower and a lender behind these things. And furthermore, they would say, oh, we're only equity traders. We just follow the news and the charts, and we're equity traders. We don't know anything about bonds. So anyone saying that is already discrediting himself. Okay. There's a thing called ISIN. Usually bonds have an ISIN. It's a standardized number. Okay, a security can trade on different exchanges, but if it's the same Apple shares, they can trade on several exchanges, then they would have the same ISIN number. It's kind of a standardized number issued by a central monopoly for issuing numbers. Okay, but they have competitors. They have the QSIP, and they have other. Bloomberg has Figgies. There's some competition in issuing standardized numbers to securities. The standardized number is at the level of the security. And of course, an issuer is a company or an individual can have more than one security issued, right? The banks, each bank have many bonds of different types that they've issued. Underlying these financial instruments, just like any financial instrument out there, is an agreement. Okay, that's written in legalese. Okay, legalese is usually English, and it's pretty straightforward. People say legalese as if it's more complicated than plain English, but it really isn't. Anyone and you can pick up a loan agreement or a bond agreement and read it. Of course, you gotta get bored, and it's not easy to read, but if you have to, you will be able to read it. There's nothing about it that uses terminology that you cannot figure out with Google. So again, don't treat this like it's rocket science. There's nothing in finance that is rocket science. And there's lots of good work to do, and you don't need to always worry about, because that's the first step. The legal setup of anything is always the first hurdle that people, when they try to do something in finance, get in trouble with. Okay, they struggle with, oh, I read that the loan agreement cannot be like this, or that I cannot do this, or the regulations like this. People struggle a lot with this, and they never get off the ground because they just don't trust themselves to be able to figure it out. But it's not that complicated. There's nothing in law that you cannot understand with plain English and reaching out to some lawyers and asking for advice. That's a big advice I can give to you. Okay, the loan agreement would specify who is the lender, who is the borrower, what's the amount borrowed, the interest rate, the repayment schedule, and additional covenants. Covenants is any kind of restriction, any kind of condition that is associated. Bond indenture is the same thing, only with a lot more details, and in particular, who is the bond trustee is in particular included. Okay, we talk about this, I think, in 2 lessons more, about this bond trustee. But the bond trustee is is an institution, usually a financial institution, that is administering the repayment of the bond, but in particular would be in charge in case of a default, would be in charge of either the administration or the liquidation of the borrower company or appointing an administrator. They would be in charge. So a bond, the whole thing about the bond is to give more guarantees and more structures to the bondholders. Okay, so that when a big company wants to borrow a big amount of money, then a lot of people can simply invest and kind of trust this setup. So in order to trust this setup and for the pension plan and the institutional investors to just kind of dish out the money, they need to trust this agreement. So if it's a standardized agreement that, like a bond indenture, that has all the required what ifs already included, then big investors, also small investors, can feel kind of more comfortable to just invest and not worry about the setup. Of course, the interest rate and the risks are important for them to decide, but then they can just focus on this and not focus on hidden items of whether this thing is set up correctly and what happens if it goes into default. Will we have someone to take care of the business, to liquidate its assets in order to pay us back in case of the default? That would be the bond trustee. So that's already pre-specified in the bond. Now with the loan agreement, it's not always specified. I can give a loan to an individual and we would write the loan agreement, and then if he doesn't pay, then this is legally binding and I can take the borrower to court, but there's not already in place a process to see what his assets are. There's not already a process in place to liquidate those assets and to repay. And it could be that there are other borrowers and it would be unclear who gets paid first. So the loan agreement is kind of the first step, and then you graduate to something bigger. You issue a bond. But other than that, both can trade. Also loans can trade. Okay, I can issue a loan, and then I get this piece of paper saying that this person owes me money. And then if there's a market for it, maybe an online market, then I could sell this loan part or this loan to another investor. And then when the borrower repays, the money would go to the new holder of this loan. Yeah, maturity, amortization. Amortization is the paying back of the eigenkapital, of the principal. Okay, so there's always, every repayment on a loan is always classified as either an interest payment or a principal repayment. Or if both are included in one payment, it would be broken down which amount is for interest and which amount is for principal. Okay, that's always critical. And also when going into court, in case of a default, the principal has much higher legal standing and protection for the lender than the interest. Okay, so if someone borrows money and then he goes into difficulties, or if a company borrows money and goes into difficulty, then they will be held to a higher standard to have to work to pay it back, the principal part. The interest, sometimes they get some sort of forgiveness, or it depends. And of course this depends on local law. In some places in Switzerland, then both I think are held to the same standard, to the same high standard. In Switzerland there's not a lot of defaults. Okay, on personal loans, there's not a lot of defaults here in Switzerland. People need to pay back. Yield to maturity. Yield to maturity is a calculation that what if all the payments on this bond would indeed be paid back, then what kind of interest rate this represents? What kind of return on our capital in percentage does this represent? Okay, so a bond yielding 10%, if pays back on time and pays back all the amounts, this would represent a 10% return on our equity. on our capital invested. The risk-free rate, this is much too too focused on. Okay, people focus on this in academia much more than is necessary. There is no such thing as a risk-free rate. Of course, there is. Okay, a deposit of a bank with the central bank is risk-free. You will surely get your principal plus interest back. Okay, because the central bank can never default, because the central bank can always just print that principal and interest to credit back to you. Okay, so a bank's deposit with the central bank is completely risk-free, default risk-free. But there are other risks, like what if this amount of money is not really worth in terms of its buying power what I thought it would be worth. That's called inflation risk, but again, I don't see the need to focus too much on this, what is really the risk-free rate. But academics obsess about it because it's kind of critical in their equations and in their models, what is the risk-free rate. But it's really not the focus of any real financier, what's really truly risk-free. People in finance, they try not to, when they're actually financiers, they try not to focus on terminology too much. They just break it down to the parts, okay? And they just evaluate things holistically. And they just go with kind of plain common sense logic. Okay, the credit spread. The credit spread is the difference in the yield of, say, a corporate bond and a government bond. So the government bond would be close to risk-free because you're kind of insured to get the principal plus repayment, because the government can always kind of refinance itself via the central bank, so they're kind of related. So the government bond is also, especially if it's issued in local currency, a government bond issued in local currency is kind of inheriting the risk-free nature of the central bank. But not if it's, but that's in your homework, not if it's denominated in foreign currency. And this is also an abused concept. People always would quote the spread. Okay, the spread on this bond is 200 basis points, 2%. But you know, it's not much longer to say that this bond is yielding 8%, and in this particular instance, I'm talking about in comparison to a government bond that's yielding 4%. So the spread would be 4%. Okay, it's just as easy to say this bond is 8, this bond is 6, the spread is 2, instead of saying the credit spread is 2%, because it's hiding what is the reference rate. Okay, and people use this in the banks. They would say, oh, this credit spread, credit spread, credit spread. People would use terminology that they kind of invented for themselves to just confuse the other people. Okay, now we're getting into the latter part of the course where I'm going to give you a little bit about the culture in the banks. Then there is this kind of, okay, this is our team, we have our own terminology, we know exactly what we are in reference, and then if someone's coming from the outside, we're going to talk in terminology, and they're not going to fully understand, and that means more power to us, because maybe the other person doesn't fully understand, and maybe he makes a mistake in the communication, and then that's more power to us, because the boss is kind of looking, and then, you know, one group is understanding more about what is talked than the other groups. Okay, it's political. This use of terminology is unnecessary, and it masks a lot of things, and again, it's for political gain inside a corporation, so more than anything, and you're going to see that. Duration, okay, you can read this. Convexity, the first and the second derivative of the price with respect to interest rate. Of course, the longer dated is the bond, there's more payments due on this bond than if interest rate rise. and again, this is a tautology. All it says that bond prices go down. But maybe I can show you this here. It just means that when things move, then the long-dated Gavi bonds move more. Okay, so this is a period where interest rates went down at all maturities, and the total return, the price, including the bond, including the coupon payments, on the long-dated 20-plus year government bonds went up more than the 10 to 20, than the 7 to 10 years, than the 5 to 7 years. Okay? It's kind of a tautology. So the duration is higher on the long-dated bonds. Okay? You just need to work with this equation that I showed you on the first slide, and you're going to see that. But again, it's a tautological. All it says is that the longer dated, the more volatile is the price. So that's really what you need to remember. The longer dated, the more volatile is the price. Of course, if I promise to pay you back in 1 month 101 in exchange for 100 that you just gave me, then if interest rates in the market, now if you can get higher interest rates on other things, then you're wanting to sell this bond now to someone else, because at 100 it's too expensive, because on this money you can get 2 or 3% for the same period somewhere else. But yeah, so it's going to go down 1% in the secondary market. But if it's really a longer dated and representing a 2 or 3% per year return, but over 20 years, then the discount today is a lot in dollars. Do the equation. Open up this equation and you're going to see that. But more than that, just open up your internet browser and look up the prices, not the interest rate, the prices of bonds of different maturities. So bonds with longer duration that are set to mature in 10 or 20 years, they go up and down in price much more than the ones that are due to mature in the near future. And that's just arithmetics. But again, there's much to focus in the media on the interest rate. And this just is, again, it's a tautology, and it just illustrates that these people giving comments are not really investors. Or they say, oh, interest rate went up, what does this mean for the economy? But wait a minute. The prices went down. Some people had losses. If you were really invested, you would talk about these losses or these gains that you've made in your portfolio. If you're really an investor, you would care about this and not about what is the interest rate and what this means to the economy, which really is an endless discussion that leads nowhere. Okay, that's credit rating. So credit rating doesn't have to be by these 3 big companies. It could also be by a small loan broker. Okay, if I'm a company that I give loans to people, and then I have this little website, and people upload their income statements, and I can do a credit check and see if they have other loans, and they can also upload their Steuererklärung from last year, and I can see their Vermögen. Then I can put all this in some sort of algorithm or some sort of a calculation, or just kind of sit down and think about it and say, okay, this is trustworthy, this is creditworthy, this is not creditworthy, or this is somewhere in the middle. This would be credit rating. Okay, it could be also done with pen and paper, or just by introspection. But they do it for the bonds. Okay, when it comes to the bond investments, then it's always done by one of these 3. Because when you get to the higher level of standardization, like when you are a big company and you want to issue a bond, then signaling, all this signaling game becomes very powerful. If you're a big company or a bank and you want to issue a bond and you want this bond rated by one of these three, because only bonds which are rated by one of these three are eligible by the pension funds to invest, because that's in their set of rules and regulations, then firstly, then you want to have it rated, but you're not gonna want it be rated by some unknown company that doesn't even exist. I don't know that there are any or many other smaller ones out there in competition. So again, it's kind of a natural monopoly, because no major company would want to have its, so I guess 3 is the right amount. But if you think about it, if the whole world is being credit rated by just 3 companies, this is already indicated of a monopoly power. So I don't know that these guys are so bad in the sense that they abuse this natural monopoly that they have come to control, but I want to highlight to you that there is a natural monopoly here. If I'm a big company, if I'm the treasurer of a bank, and I want, because it suits my financial goals, to issue a bond, and of course if I'm issuing a bond, then who's going to invest in it? The pension plans and the insurance companies and large institutional investors, sovereign wealth funds, and so on, and mutual funds. Then I need to get this credit rated. And if I'm going to get this credit rated, then who am I going to go to? Let's say there's a new one in town that's trying to set up shop, but nobody else is using them. And I'll be the only one having a credit rating by some unknown companies. And of course I'm not going to do that. Okay, because this gives a very bad signal to the other institutional investors, which are highly sensitive to such signals. Okay, they need everything to be standardized. Otherwise, they are, seen as doing something politically risky for themselves. They might lose their job. Okay, so obviously there's a monopoly power here. During the financial crisis and leading up to the financial crisis, these companies got into some trouble by, they get paid by the issuer. Okay, there's usually not a problem with this. And also during the financial crisis, it's not clear that they were really corrupt in any way, but they just made a mistake, okay? They got some heat for giving high ratings. Hello?
Sorry for interruption, you need to take the microphone for
Oh.
the podcast.
Sure.
Thank you.
Thank you, sir. Apology. Big brother's watching. All right. So I'm videotaping now, so it's gonna be on YouTube. You can check out the YouTube. And so yeah, I don't know that these guys are really abusing their monopoly power. So, but just to let you know that in finance, there are a lot of these natural fountains of monopoly power, okay? Money is a natural monopoly. Separately from money, capital is a natural monopoly. The dissemination of information, like these big companies like Bloomberg and Reuters, is a natural monopoly. These credit rating companies is a natural monopoly, okay? So it's very hard to bring up competition for this. And you're going to see this everywhere. And I think this is very important, because how can you even go through finance education and not highlight these monsters, okay? I'm not saying they're bad or good. I mean, if you can't beat them, join them. If you get a good job in one of these monopolies and be monopolizers, go ahead. It's the best way to make money, best way to get ahead and accumulate your capital. Yeah.
But somehow it seems that those rating agencies would be the easiest point to manipulate and to gain a lot of money. For example, if you downgrade a rating of a big country or AAA to AA, let's say, then the rating would go up skyrocketing, right? So it seems like too easy to be true.
Yes and no. I mean, if you're sitting here in a class and imagining it, I can see the logic how you might think that this could really happen, and it can really happen. And it's a judgment call whether this is really happening in reality or not. But my opinion and my experience is that this doesn't really matter. So when the U.S. got downgraded from AAA to AA, yields actually then the bond prices actually went up when that happened. The day that one of these downgraded the U.S. from AAA to AA, you would think that the bond prices would go down, meaning yields would go higher. But it didn't. It went exactly opposite. Why did it go exactly opposite? Maybe it has nothing to do with that, or maybe that's what was kind of in investor's mind at that time, is that, well, this is a bad thing, and maybe the whole economy is going to slow down because of this, and then if the whole economy is slowing down, then interest rates might go lower in the future. And bond prices, government bond prices actually went up that day. Is that right to have happened? Also probably not. These things don't really have such a big impact. Okay? And then if you're thinking about the corporate bonds that these guys are giving ratings to, then I never really saw deep into it, but there's not a lot of rumors or noise out there or indication that this is kind of corruptible or corrupt. I think it's pretty standard, and to be honest, it doesn't really have the big effect that people think. It doesn't really have the big effect that people think. Payment in arrear or in advance, this is just terminology. So you pay your rent in advance at the beginning of the month, but you get paid as an employee at the end of the month. And herein comes what's called payday loans, right? So short-term loans against your future salary. So if you are a hard-working person and you live paycheck to paycheck, and then something happens, you can't pay your rent, but at the end of the month you're gonna get your paycheck, then you can go down in the corner of the street and you find this pawn shop, and they would say also payday loans. And this is a huge market. People laugh like as if this doesn't exist, or really people in very dire situation that they brought it on themselves and they shouldn't be in that situation should walk into such a store. Maybe yes, maybe no. The point is that there are millions, tens of millions of people borrowing personal loans all over the world, like you wouldn't believe, okay? And it's been around since forever. It's been around since forever. Delinquency is an interesting word. Is when someone misses a payment, is the delinquent. So a juvenile delinquent, okay, is also a person who's underage and he commits a crime or a felony, is a delinquent. Deferment or forbearance. Deferment, sometimes student loans, the repayment of them is deferred to a later date. Okay, because only a year after you begin your job, maybe the original loan contract says that as soon as you graduate, you need to start paying back. But then there's maybe a clause there that says, well, if you can't really find a job, then we can defer the start time of you having to begin repaying to an additional year after you graduate. So give you more time to find a job. So that's called deferment. Or forbearance is may be granted at the lender's discretion during a temporary as a temporary relief, an alternative to default. Okay, so if I would lend to a real estate project and things happened that it's taking a little longer, but it looks like it's gonna be finished in 2, 3, 4 months, then I can give an extension. It's basically just an extension, and most times it makes more sense than to just say, well, that's it, you didn't pay in time, this goes to court, because that's costly and takes more time. Most times it just makes more sense to extend it, but of course there must be a cutoff where you have to take people to court, have to take real estate developers to court, and then that would be a default. There might be some renegotiation, and then bankruptcy. That's the final stage. Okay, bankruptcy is legal proceeding when a person or a business cannot meet its financial obligations as they come due. It's usually, between 60 and 180 days. Usually after 180 days, of not paying back on a personal loans in the US, then the lender writes it off and this goes to court. Anywhere between 60 days of non-payment and 180 days of non-payment triggers usually a bankruptcy. So a bankruptcy could either be filed by the debtor. So if I'm a personal borrower and I have so many debts, then at some point I say, okay, I'm not paying on any of these. I go to the personal concursamt, I go to the bankruptcy office. In each country there's some other kind of government entity that's in charge of this, and file for bankruptcy, and then that gives me protection against my creditors. I don't have to pay back immediately, but then it goes to court and there's or to the bailiff, and then my debt is kind of broken down over time in a sustainable way, and usually I would be held accountable under most laws for the principal borrowed. Okay, so, but also some principal sometimes doesn't have to get repaid. If the situation is so bad, and then the principal is what people negotiate even after for years. So if a person goes into personal bankruptcy and he gets some forgiveness on the interest, but the principal doesn't really go away. So people have to pay back principal under most laws. And then if they can't even pay principal, then this thing gets dragged on sometimes for years. They try to get money back from them on the principal. Okay, then the debtor's assets are used to repay outstanding debt. So jumping here a little bit, there's secure debt and there's unsecured debt. Secure debt would mean that specific collateral is pledged against the loan. So think of a company. The company has computers, they have equipment, they have patents, they have intellectual property. All of these are assets, but in particular they have one building. Okay? And then the mortgage lender against this building would have a secured claim on that building. Okay? So in case of bankruptcy of this company, the mortgage lender would get the house, this building, and everything else would go to the other unsecured debtors. Okay? So he has higher priority in case of a default. That's why it's called a secured debt. And then one needs to think about recourse versus non-recourse. So let's say the borrower defaults, then okay, I'm the secured lender, I get this building, and then I sell this building in an auction, and this fetches whatever amount. Let's say I overvalued it, and then I lent 100, and when I sell this building in auction, it fetches only 90, so the guy owes me another 10. The company owes me another 10. So if it's a non-recourse secured loan, then the company doesn't need to pay me the extra 10. I just get the 90, what I got from selling this building. If it's a recourse loan, that means that I can go for the extra 10 from the company for selling its computers or selling its intellectual property. Okay, that's the difference. And then you can have additional guarantees. Sometimes you would get an additional guarantee from a director of the company, from the shareholder of the company. They might give a personal guarantee. And then there's unsecured debt. Unsecured debt is a loan made either to a person or to a company that is not backed by any one particular asset of this person or of this company. But the fact that it's unsecured debt does not mean that the borrower simply cannot repay. If they don't repay, then this borrower would be pushed into bankruptcy by the creditor, and then whatever assets he does have are subject to liquidation, to be sold in an auction in order to repay the debt. But of course the interest rate on unsecured debt is higher than the interest rate on a secured debt, because secured debt, as the word suggests, is that much more safe. Issuers, borrowers, okay? Natural persons can be borrowers and investors, or legal entities. And this distinction is the only one out there that you need to remember. There are no other types of borrowers or investors. Or there's either a natural person or a legal entity. A legal entity in German is juristische Person. Okay? This is. Well, let's take a break now. Natural persons and there are legal entities. Legal entities is a human invention for a company or a partnership or a trust. These things, it's like they have a life of their own. Okay? Legally speaking, they have a life of their own. Of course, you cannot hide behind the company just committing crimes because you will be held liable personally. Okay? So there's only so much that a company offers you. It's not really a magic mask that you can hide behind. But this is necessary and useful and is used a lot. And Apple, all these companies that you know, university, they are all legal entities. And then when it comes to natural persons, there's the important distinction whether it's a tax resident or a non-tax resident. Okay? The definition of what is a tax resident can be tricky, and you can find ways to work this to your benefit, or if you're not aware, this can work to your disadvantage. Where you are a tax resident. Okay? And then also as an investor, it might matter if you invest in, say, Swiss or US equities, then there might be the issue of source income tax withholding, and this would matter if you are a tax resident or a non-tax resident, but we can postpone this to a later course probably. Legal entities, there's a sole proprietorship, Einzelfirma in German. This has unlimited liability. Okay, there's only really two main issues about these legal entities. What's the difference between them? Is whether they have limited liability or unlimited liability. Of course, this does not, financially speaking. So if a company almost always has limited liability. That's kind of at the definition, the heart of the definition of what is a company. It's not just the name, but what makes it a company is the fact that it has limited liability in the financial sense, meaning that if the company gets into trouble, cannot pay its debts, then whatever is owed in excess of what the assets of this company are worth after they've been sold, then you cannot go after the owners of the company. Their wealth is ring-fenced, okay? Is protected from whatever debts of the company. And this is what limited liability means. If the directors of the company commit a crime, then they're not protected. If they commit a crime on behalf of the company, then they're not protected by this limited liability. This limited liability is only for financial matters, for debts. Okay? And then there's the issue of tax transparency versus tax opaqueness. Okay? Tax transparency means that whatever, and partnerships are usually tax transparent. Now this is what makes them partnership. people get confused by the name because nobody explains what this means. Or you think, oh, partnership is a group of people setting up like a partnership together and they're doing some business and then they split the profits and split the costs. That makes sense. But wait a minute, what's the difference between a partnership and a company? It's also a group of people getting together and setting up a business. So why you call this a partnership, you call this a corporation. The difference is in the tax treatment and also sometimes in the limited liability. A partnership can have limited liability. An LLP in the UK, limited liability partnership, is both a partnership, which is tax transparent, and I'll explain in a second, and has limited liability. But in some other jurisdictions, the partnership, as per the law, has unlimited financial liability to the partners. So that's why I leave it unspecified. But the concept of tax transparency means that the partnership, if it's legal, if it's tax transparent, and it usually is, does not pay corporate tax, does not pay taxes as if it was a person. But corporations, they are treated just like they were an individual. Of course, it's called a corporate tax, it's not the same tax rate, but they are taxed on their net profits as if they were a separate legal entity, which they are. And that's what it means, tax opaque. Tax transparent means that the partnership itself is not taxed, only what is net profit distributed to the individuals, which are the partners, they have to pay the tax individually. So then you might think, well, isn't it better than to always have a partnership over a corporation? Then the answer is a bit more complicated as far as the disclosures and as far as what is allowed, not allowed, it gets tricky and complicated. So tax law is quite tricky and complicated, but again, it's not rocket science. And trusts are yet another thing that usually offers limited liability, can give different degrees of anonymity. There's some islands that you can set up a trust and it would be anonymous who the beneficiaries of the trust are. But then if you have a trust that is incorporated in such a jurisdiction, such as the Cook Island, that hides, as per law, who the beneficiaries are, then probably no bank will ever let you open an account. So the world has evolved such that all these places where you can hide, the legal framework allows you to hide, then the financial institutions don't let you hide. So it's really become difficult to hide money. Not that you guys have any money to hide, unfortunately. Okay, special purpose vehicle. This is a word, again, obviously abused in finance. When people don't know the difference between a partnership or a corporation, which this is what the difference is, if the tax transparency has a limited liability or not. These are the two kind of main differences, main features. When people don't really understand it, they call things a special purpose vehicle. But a special purpose vehicle is not a legal definition. So a special purpose vehicle is kind of a description of the purpose of this legal entity, which could be a corporation or a partnership. So the corporation or a partnership are the most common forms of legal entity that you have out there. A special purpose vehicle is just a name for a one-time legal entity. So let's say we form a partnership, me and 3 of you, then we're just gonna buy this building over there. We're gonna renovate it, sell it for a profit. We have a plan for it. It's gonna take about a year or a year and a half. So we're gonna set a company or a partnership, depending on how best it is for us tax-wise, and then the legal entity would borrow money if necessary, and we would also contribute some of our own money as equity capital. We'd buy this building, we renovate it, we sell it for a profit, then we'd have to pay taxes on the profit, and then we're gonna kind of liquidate this company. Again, the word liquidate in this sense means that we're gonna strike this legal entity from the Handelsregisteramt. We're gonna delete it from the company registry because it was just set up for this one purpose, and that's why it's called a special purpose vehicle. It's just a name. Yeah.
So is the how do you say the framework that you have a special purpose, and after the purpose is fulfilled, you resolve the
You don't have to. You can use it twice. But the point is that let's say I'm a bank, and I do with the regular banking, take deposits and lend mortgages and do this other stuff on daily basis, and then this big legal entity that's been around since forever takes in a deposit. It is the counterparty between the depositor and the bank. This one legal entity is the bank, and similarly to the loans are given to the borrowers from this one legal entity. This is kind of the daily business. But let's say the bank has one idea to buy some loans in some other country, and they don't want it on their balance sheet, and they want this to be just kind of for a few investors. They kind of want it as a satellite thing. And they can do this once or twice with the same entity, but maybe they just do it once. But that's the point. You kind of make it clear that this is a separate legal entity, not the regular entity. Okay, state and municipalities, governments, supranational institutions, all of these would issue bonds and borrow money and finance big projects, finance bridges, the roads. Okay, you can read about this. The diversity in bond versus equity markets. So one of the reasons that you and also me when I started, we get so fascinated by the stock prices more so than the bond market, right? How many of you know the price of any one bond? How many of you follow the prices of Apple or Tesla or any kind of stock? Let's see, show of hands. How many of you follow stock prices? Any with one stock? That's quite a few. How many of you follow the prices of any one bond? None of you. Okay? So you see, I didn't invent that this is a bias. I didn't invent that this is a behavioral bias. Now the reason that you follow the stocks more than the bonds is because the stocks have a chart that you can follow up and down and read the news and try to imagine what will happen in the future. So that's why you're watching the stocks more than the bonds, and that's why it's all over the media more so than the bonds. But actually the bonds are a somewhat bigger market than the equities. Not that much bigger, but roughly the same, depending how you count. But they have much less liquidity. Okay, again this word, in this case I mean the amount of trading that goes on in bonds relative to the market capitalization, relative to the value of the money that is owed and money that is owned, is much lower than it is with equities. Okay, so there's trillions of dollars trade back and forth between buyers and sellers of equities, but the bonds, they don't trade so often. And if you take even a corporate bond of a medium-sized company, if you want to buy it and then you change your mind and you want to sell it, you might pay up to 1% of a bid-ask spread, because it's not that liquid in this sense. This is one of the kind of usual use words for the word liquidity. But the equity is much more liquid. It's only be a few cents that you can buy and sell. Okay, and there will be lots of buys and sells. Why is that? Okay, so again, we're going into theory and explanations why this is, but this is quite straightforward. There's only one equity. Think of a bank. Because a bank is the most complicated financial institution as far as the diversity in its liabilities and in its assets. Banks are the most complicated financial companies out there, financially speaking. The balance sheets, and if you read an annual report of a bank, it could be 500, 600 pages. So that's the most complicated stuff. And any bank can have up to 20 or 30 bonds outstanding at any point in time, with different maturity dates, different coupon payment, different features, different seniority in case of default. This one would get paid first. Some of them would be off balance sheet, backed by mortgages which have been taken out of balance sheet and into a special purpose vehicle. Some of them are against the main legal entity, which is the bank, and then it would have seniority which varies. Maybe if the bank goes into default, this bond would get paid first, this bond would get paid second. So different degrees of seniority, different features, and then, but one equity. Okay, so the equity is a focal point for whatever is the residual value of the bank's assets after all liabilities are paid for. And then that's kind of a focal point that's easy for many market participants to focus on. And there's a lot of buying and selling of the equities, but not so much disagreement and trading in the bonds. And also it's kind of spread out over many, and that's kind of one of the explanations. There's other explanations like the market structure. The equities are usually listed on standardized exchanges, whereas bonds trade up until recently almost exclusively in OTC markets, over-the-counter markets, meaning that it's kind of a market by phone calls or by kind of pinging each other or by email or with chat rooms between the banks. But this has become also much more standardized, and some bonds have been moved to trade on exchanges. And this did alleviate some of the illiquidity problem in bonds. That for a while there was kind of a problem in this. The people were complaining that there's not enough buying and selling of these bonds. And these are part of the explanations. And you're going to notice this. And to really understand finance, first you need to understand what is a loan and what is money. And then you can understand what is an equity, because it comes natural and it's not much different. But if you're just thinking equities, you may very well be biased by technical analysis and reading the news. You may very well be biased in this direction. Interest rate schedules, okay, there could be a fixed interest rate or there could be a variable interest rate. There can be pegging. Okay, you might want to think, could be a good question for an exam. What's the difference between a bond which is denominated in a local currency, say in Swiss francs, but the payments are pegged to the US dollar? So if the US dollar goes up versus the Swiss franc, then the amount of Swiss franc you need to pay back on the loan increases. What's the difference between this is a Swiss franc denominated bond which is pegged to the US dollar versus a bond which is exclusively denominated in US dollar? So in dollar terms it would be the same, but the difference would be legal and the actual currency that's being moved around. The difference would be whether I'm sending an equivalent amount of Swiss franc or I'm sending just dollars. That would be the difference, but economically it wouldn't be much of a difference. Just think about this. Amortization schedules. Okay, now there could be different schedules to how you repay the eigenkapital. So maybe you say that usually personal loans are structured as an annuity, and also mortgages. Because people have jobs and they usually make a monthly salary, and then they can pay kind of a fixed amount every month. So that's why we set it up for them that when they borrow money, that they need to pay it back in equal payments. Now these payments are comprised of both principal and interest, and the kind of mix of what is interest and what is principal of this fixed payment changes over time. So at first, you pay back the interest on your mortgage, and later on you pay back more of your principal. You guys know this, they call this the Spitzer table, some guy that made the table. Okay, or you can have other kind of schedules of principal payment. And The idea is, and you guys should ask, oh, wow, this gives me a headache. How do I know when it should be this principal repayment schedule or that principal repayment schedule? And the answer is, when you go into a business, when you're talking about an actual business that needs to be financed, the natural way to finance it will reveal itself if you understand the business which is being financed. Okay? If you're financing a real estate project in construction, okay, then it most likely will be a bullet payment. Why? Because maybe it takes a year to renovate until it's ready, and then it's sold, but during the year that it's being renovated is not producing any income, so it's unreasonable to ask for interest, let alone principal payments during the year. But then when it's sold at the end of the year, it makes total sense to ask all of the principal and the interest at the end of the 1 year term. Okay? So the point is that ideally, the loan liability repayment schedule of interest plus principal would be aligned with the cash flows of the business or the asset which is being financed. And then that is efficient if you think about it. Because if I would lend more, then that cash would be kind of sitting idle in the borrower's bank account, not earning interest, and that's inefficient. Maybe you wouldn't be able to pay such a high interest rate. So it's efficient to always match the repayment schedule of the loan with the cash flow characteristic of the business or asset which is being financed. Okay, think about it, it makes total sense. And then when you really go into finance, you're not gonna go back to my class and remember which word means what. You're just gonna understand what is this business or asset that's being financed, when am I gonna see them, when is the borrower gonna see the money back, and then that dictates when he can repay. And you're gonna structure it from the beginning to be aligned with that repayment, with that cash flow schedule of the asset. Bond insurance and a credit default swap are again the same thing, only a credit default swap is more standardized than trades, not on exchanges, but trades over the counter. And it's an insurance company would guarantee a schedule of payments of interest and payment on a bond of another issuer in the event of a default. So let's say I'm a company, big company, and I borrow money from all of you in the form of a bond, and then there is an insurance company there, has nothing to do with me, but they say, we did our research, we're willing to sell you insurance, if you guys want, that you will pay the insurance company a regular premium, a regular payment, as long as I'm paying on the bond. But in case that I default on the bond, then the insurance company will make you whole, meaning pay you what I didn't pay you. But for this you need to pay. This is insurance, bond insurance. In which cases does this make sense? Honestly, I don't know. I don't have a good intuition to give to you exactly when this makes sense, but obviously there's a market for this, and if you dig deep and see who are the buyers of insurance and who are the sellers of insurance, the sellers of insurance I can understand because you get a payment every month, and even when you average out the times that you need to pay, you're still making a positive expected return. Then that's the natural seller. So this can understand. Who buys bond insurance? When does it really make sense to buy a bond and at the same time buy bond insurance? Hard to kind of give intuition to this. But there's a market for it. These are different features of a bond. A call feature is that if I issue a bond to you, I may say that under some circumstances I can repay early, okay, at par value. So if I borrowed 100 from you, now I'm paying interest every quarter, and then at some point at my discretion I can say well, I'm gonna pay you back the 100 and that's it. And some bonds have this call feature. If I do that, I'm calling on the bond, and if not, then I don't have that. Of course, this gives me an extra option relative to not having a call feature. That's why it's called a call option. Then it has some value, and therefore usually the interest rate that I would have to pay ex ante is somewhat higher than if I didn't have this call feature. And you can read here the early repayment when it makes sense, or you can Google it and try to think of circumstances where this option is valuable to me and it comes to you at the wrong time. Then it's kind of that's why you demand a higher interest rate from me to begin with to give me this option. Covenants, restrictive covenants. Now, people don't just give money to companies and to individuals or to real estate developers unless there are enough kind of covenants in place to make sure that the money is not going to be squandered away, and then after a year they're going to come back and say, oops, we don't have the money, but we are a limited liability, you cannot come to us. But in fact, so firstly is CEO compensation, okay, and employee compensation. Think of me as a borrower. I just told you that that I set up this company. Now the company will borrow money from you, and the stated purpose would be to buy this building and to renovate it. So yes, I buy this building with your money, but then a lot of money is left still to renovate it. And instead of renovating it, or I renovate it just a little bit, at the same time I increase my salary from the company by a factor of 3. So then the money is being, then most likely this company will go into default. But I kind of bled this company out. Now, you didn't intend for me to do that when you lent me the money. You didn't even think that this would be ethical. But of course, this has happened a million times before. So this would be a very basic covenant. So in the loan agreement, specifying on the borrower, you the lender, this is the amount, this is the interest rate, this is the repayment schedule, and these are the covenants. You may not increase your salary or take any salary until you pay us back. You may not take a dividend from the company until you pay us back. You are not allowed to start another project or borrow additional money until you pay us back. So all these things make sense as additional covenants and under certain circumstances. Of course, I might push back, and then we would negotiate. So you have to understand there's always a borrower, there's always a lender, there's always other options. And you know what? It's not that hard to agree. When people are actually business people, and we're talking about an actual kind of business opportunity that people can evaluate and see the expected profit, there will always be an agreement. We will agree on a subset of these, we will trust each other, and we'll have the legal setup in place such that if it doesn't work out, we'll be able to resolve this either out of court or in the courts, and everyone will be more or less happy ex ante when we go after this adventure. And these would be part of it. So we would say that this real estate building, that I cannot borrow an additional amount against this building. I cannot pledge this building as collateral against any other loan. So these would be asset-related, restricted. It's not really. It doesn't really matter how you label them. Okay, we just know these things are out there. And of course, every money coming out of the company, this needs to be really controlled. When you're lending, especially to a small company, you must really control. And in many cases, the lender, if the borrower is a small company, the lender might get either exclusive or joint signature on the bank account of the company. Okay, so it would be not only in the agreement, which the agreement can be broken, then when I'm lending, I would actually say that one bank account that you're gonna pay in and out to do this business that I'm lending you the money to, every time you want to pay out anything, when money comes in, no problem. When money comes out, you have to come to me to sign it off, okay? Else I'm not lending you the money. So this is possible, and it's out there. This is especially for smaller companies that are doing kind of risky business or business that is not very highly regulated, not very highly controlled, that they can do kind of what they want. Bankruptcy, let's talk a bit about bankruptcy. This is the part when I talk about personal that the people start kind of sweating in their chairs and feeling uneasy when I talk about personal bankruptcy, because people associate themselves with the borrower more than the lender. And that's okay, you can start off as a borrower and graduate to becoming a lender. Unsecured personal debt, like I said, when a person borrows money, even that there is no particular asset that's secure in this loan, does not mean that the person simply cannot repay. He must repay. But if this goes into the unpleasant situation of a bankruptcy, either voluntary or involuntary, so if sometimes the borrower would go voluntarily into bankruptcy, but sometimes the lender would push someone into bankruptcy in order to get a payment order from the court so we can freeze their bank account. And so money in bank accounts, your bank account can get frozen depending on the laws of the country. So in different countries you can do different things to borrowers in default. I'm talking about personal bankruptcy. You can freeze the person's account. You can get wage garnishment. This is a word in Old English, but this exists also in Switzerland in a big way. That if someone doesn't pay back its debt, then there is a court order after we go to court. And if you don't show up, this happens anyways to my benefit as a lender, that any employer of yours will have to pay what is determined in court to me as a lender before it goes into your bank account. Okay? And then if a person has already a job, this would be extremely embarrassing in a small country like Switzerland. That I'm a lender and I would come to your employer with a court order that you have to pay me first 10 out of every 100 that you pay him as a salary, and that's a huge deterrent. Okay, there's collection agencies. Probably there's several layers. There's the capitalist layer that is just allocate the capital, and then there is the company that I call it the loan broker. Then they do the due diligence. They have the website that people can upload their documents and apply for a loan. And then either the loan broker would do the collections, or sometimes the loan broker would work with a collection agency. A collection agency would have people on the phone and they know how to call you at like 5 or 6 o'clock when you're on traffic, back from work, to nag you, and all sorts of letters, first one. But eventually, you know, they can't really do anything to you. So eventually, nowadays, you can't do anything to scare you off. I mean, this is a first world country, even second world country. You can't do anything to people. So these collection agencies, they're just nagging nannies, so they can't really do too much. But at the end, this goes to court. But yeah, there is this. They come and sandal your car. You know what is sandling a car? You take this metal thing and you kind of lock the. You take the car away, or you just sandal it. So as soon as there's the payment order, you pay the collection agency. The collection agency knows the address. They would go there and they put a sandal on the car, so the guy can't drive his car away until they take the car, sell the car to pay back the debt. So you know these kind of physical things. Then you'd have these companies that specialize in this. Yeah.
Does this also happen with pets?
They take their pet? I don't know if they take your pet.
And if it would be a horse?
They can
Because
take, if you have horses, they take your horses.
But that's also a pet.
Depends. If it's one horse, maybe you can get away. There, maybe a court would see it as a pet. But if you have more than one horse and you're spending money regularly, I'm pretty sure the court would see this as an expensive pet and an asset. That's a good question. Corporate debt. So again, going to this concept of a pecking order. This is a concept of pecking order. So if there's a company, and let's say it has some tangible assets like a building, and then it took a mortgage against this building, then if this company goes into default, first lender that gets paid is the mortgage lender. Because first they sell this building, and whatever money goes to the mortgage lender. And then whatever is left can go to the unsecured corporate debt. So banks and other companies, they have more than one type of debt. They would have a mortgage against the, so just think of a person that have a mortgage against their home, but also they have some credit card debt or a personal loan. If this person goes into bankruptcy, the mortgage lender would get paid first, and the credit card company would get paid second. So that's the pecking order, and that becomes important at some point. Government debt. This is a good book. But then again, it's written quite melodramatically. There's only one thing, and this is in your homework, that one should keep in mind about governments and potential defaults by governments. This whole book is just different examples and kind of dramatically overstated. That when a government borrows in its own local currency, then it can never default, because it can always monetize its debt by rolling it over and convincing the central bank to purchase to refinance the debt, to give it more money. Okay, and this usually comes at the expense of inflation, but let's not really worry about this. Just say. But when a government can really default on its debt is when a government borrows in foreign currency. So let's say a government is some Zimbabwe or some funny country with not stable financials, then but they need to buy oil and import stuff and finance themselves, and they can't really do that just by borrowing from their own people in local currency. So they would borrow in hard US dollars, and this they can default in a big way and really not be able to pay, because their liabilities are in dollars and maybe their local currency is not worth very much, and then no matter how much they try to print their own currency to buy more dollars, then the market realizes this, and then the value of the currency against the dollar tanks. So no matter how many funny money they print to buy real dollars, they can't and they can't afford to repay. And that's the whole book, and that's the whole thing you need to learn about government bonds. Government bonds, they're truly risk-free when they are in local currency, but they are not risk-free when they are in foreign currency.
But could not a government, like for example the USA, like they almost defaulted on their
that was a technical default.
Pardon?
That was finish your question.
Like what I want to ask is like, isn't it the case that sometimes due to politics internal, they could, let's say, like, no, we're not printing.
This is the debt ceiling.
Yeah.
This was the debt ceiling, and this could potentially have happened, that the U.S. had some arcane rule that they couldn't quickly change because the other party was holding. It was the Republicans holding the Democrats hostage, negotiating with them, saying, no, we're not going to approve this little technical change so you can pay back because we want to embarrass you, or unless you give us this and that. And they played it like this. In this case, it was the Republicans playing the Democrats like this. Nowadays, the Democrats are playing Republicans like this. And just goes to show you how negative bipartisanship can be when people just view things as me against them instead of being professional and this can be devastating for any company and any business. Yeah, so that could have happened. So they could have missed the payment until they figured it out and got consensus. That could have happened. But you know what? When that happened, the stock markets went down, I don't know, 4 or 5% quite fast over a few days, and the VIX really spiked. And guess what happened the next Monday? You know, they shook hands, they solved it, and then it was over. And the point is that the equities, they represent a claim against McDonald's, against Visa, against all these companies. You wake up in the morning, McDonald's is still there, right? People still walk in, they still make profits, right? So the equity is still making dividends.